While people are making their way here from the coffee break, I just wanted to make one quick announcement. There's a typo in your program on page 24. It says that if you're submitting a paper to IAER, that you have to have it submitted by January 15th, and that's incorrect. So it's June 15th, and it says your paper from Savannah, and it should say your paper from Milan. So anyway, the old ad got copied and pasted. So if you decide to submit your paper from this conference, incorporating comments that you received from the discussants, the attendees at your session, et cetera, incorporating those comments into your paper, then you have until June 15th. So I just wanted to make that clear. So without further ado then, today we have a very exciting panel. The panel was organized by our president, Charles Calomiris. And I'm going to turn the podium over to him and let him introduce his speakers.
Thanks very much, Kathy. And if I can also take this opportunity to thank Kathy and the staff for a wonderful meeting here. I'm sure everyone will join me in expressing our appreciation for the wonderful facilities and the efficiency with which you've done it. Thanks very much. The panel that we're going to have now is on the European banking crisis. It's a crisis which perhaps is one of the longest lived in some sense, or multi-phased banking problems that we've seen in the modern era, I would say. You can talk about the beginning of it, excuse me, the beginning of it at the time of the US crisis. But then it continues with the U.S. money market mutual fund shock that afflicts the European banks about a year after the U.S. banking crisis. And then further problems as accusations mount that problems in the sovereigns are now infecting the banks, and that the banking systems in the various countries are only too willing to accept the sovereign debts of their local governments because of their own concerns about showing to their sovereigns that they're solvent. And so this sort of deal of the sovereigns pretending the banks are solvent and the banks pretending that the sovereigns are solvent as a sort of mutual deal becomes the new theme. And then we have a tendency not just for the balkanization of the holding of sovereign debts on a country level basis, but also apparent balkanization in lending, which we'll also hear a little bit about today. That is, countries reverting to lend more in their own domestic economies, the banks lending more in their own domestic economies than they used to. And then, of course, a new phase, which is the perception that it's important to climb out a little bit of the political economy of domestic national supervision of banks by creating a consolidated supervisor in the form of the ECB, and the creation of a new deposit insurance model for all of the Eurozone. So this new system, which is still, I would say, under construction at the ECB, is all being developed too at the same time. So it's a huge amount of interesting themes, but then, of course, something else new, which is crisis lending by the ECB, a financial intermediary that just comes into existence as a central bank with the dawn of the euro, and very quickly has to figure out how to do emergency lending during these various problem periods. And then the question arises, what effect does its emergency lending have? If it's supporting weak institutions, how does that affect the overall financial system liquidity? Does it promote liquidity among the banks? Does it rescue the wrong kinds of banks? So as you can see, we thought that a panel on European banking during the crisis would be an interesting topic area. And in designing this, what the panelists and I all agreed on was that they would try to talk about their own most recent contributions, each of them has more than one contribution to this literature, and I think we've assembled a pretty good group with a wide knowledge of the various topics I've just summarized. But we're going to start with some specific contributions of their most recent work, and then what we're going to do is, after they've each spoken for about 15 to 20 minutes, then we're going to open up a discussion. I'll raise some initial questions, and then also open it up to the floor for a discussion. Let me mention the panelists to you. I won't give you their full bios or even much about their affiliations, except to tell you where they're from. Starting from my far left, Florian Haider is a principal economist in the Financial Research Division of the ECB. Sascha Steffen is an associate professor at the European School of Management and Technology. And Aurore Burietz is just about to become a postdoc at the Free University in Brussels. Well, let's begin in the order that the program appears with Sascha. So, Sascha, the floor is yours.
Okay, thank you very much, Charles, and the organizing committee for inviting me to this conference. I'm very delighted, we are delighted that the paper, or that we can present the paper, and I'm particularly that I'm able to come to Milan to present it today. It's a joint paper with Viral Acharya from New York and Diane Perret, who's from HEC Lausanne. And so what we're doing in this paper, or maybe a bit broader question that we pose is, how does the supply of public liquidity affect the supply of private liquidity? In particular, we're looking at the supply of US money market mutual funds to European banks. And the banks, because of their exposure or because of their funding from the shadow banking system, are exposed to funding risk and also market discipline. And we are interested in analyzing as to what happens or as to what changes during the crisis when the ECB starting their various non-standard policy mechanism. So just if we look at what happened during the last couple of months and even years, so we still, if we look at GDP growth in the Eurozone, excuse me, it's still relatively weak. We have very little growth. And despite the series of policy interventions that we have, and even now the ECB started with the quantitative easing program, and just let me go to this graph, which nicely compares both the GDP growth as well as lending growth in the Eurozone relative to the US. And as the blue line always is for the Euro area, the red line for the United States. And what can be seen in the upper panel is that while the US exhibits a stronger growth during the last couple of months, the Eurozone growth is basically declining or even flat. And this can be nicely related to the growth in credit to the non-financial sector. While there is an increase in credit going from to the US economy, there is basically very little change in credit to the real economy. So this is something which might probably have, at least to some extent, explains the lack of growth in the Eurozone. So what Viral and I have showed in an earlier paper, that this type of short-term funding exposed banks to substantial stress in 2011 in particular, and the ECB responded with the two first 3-year ELTRO mechanism and a substantial reduction in quality of collateral they were accepting in their regular transactions. So to summarize that, and the question that we're trying to answer is, so we're looking at the provision of short-term funding by US money market funds, and we're interested in finding out whether or not these funds were able to distinguish between whether this bank is a high or low-risk bank, because then we get sort of a feeling of this market discipline effect, and then also investigating further the source or the types of funds. Are US money market funds able to differentiate between unsecured and secured investments, and particularly how did this change when the ECB started a series of interventions? And sort of the main results or punchline, what we observe in summer of 2011, when the economy was in substantial stress, we saw stock markets globally, or particularly in Europe, declining, market shares of banks falling by more than 40% on average. We saw a substantial run of money market funds on the unsecured funding of high-risk banks, while the US funds maintained their unsecured exposure and even increased the repos, or the secured exposures, to the low-risk financial institution. And interestingly, after the series of policy interventions, we see that kind of reverting, so this market disciplining effect disappears, and the money market funds start to invest again in the same high-risk banks after particularly the OMT announcement in September 2012. So I think this is a very robust and very important result that we have. So the data that we use money market funding that we get from iMoneyNet, which is collected by them from the SEC filings, given regulatory changes in the US. This is available starting November 2010, and we have that until August 2014. Market data is coming from Bloomberg, and the interventions, we collect that from the ECB website ourselves. Just to give you a very brief overview of this type of funding, so these are time series averages, not cross-sectional. So for example, what we see here is that particularly related to unsecured funding, the amounts on average are even to some extent larger than the most important repo funds. And here when we talk about repo, what we regularly mean is repo transactions backed by US securities, government agency, and treasury debt in these types of transactions. We see that the average maturity of unsecured debt is substantially higher, and of course, given higher risks, also the yield on these securities is also very high. The different ECB interventions that we're trying to look at is, and I try to highlight this in red, is particularly the SMP program in August 2011, the LTROs at the end of 11, beginning of 2012, then most importantly maybe the OMT announcement in September 2012 after Mario Draghi made this speech in July, I think, that he will do whatever it takes to save the euro, and then also the forward guidance in July 2013 when the ECB said that the interest rates are going to remain at a very low point for the foreseeable future. And I think this is a very graph that shows almost everything from the paper. This shows you the principal amounts of the unsecured, that is the blue line, and of the secured, the repo funding, for all banks over our sample period. And this is what I meant with a substantial run by the money market funds in 2011. And then in 2012, we see this reverting. We see an increase even in unsecured funds for the European banks. And we see to some extent at the same time a decrease in repo funding, so substitution from the secured to the unsecured funds. And we show here, because the repo is to some extent is a serious seasonality, which is, from my perspective, I think the most important reason is the window dressing by European banks on the quarterly level to at least kind of on the book reduce that type of leverage. So we need to take care of that when we do our empirical analysis. So the first question aims at looking at the kind of a market segmentation effect. So do money market funds particularly target the euro area banks relative to other banks? And we can differentiate between the banks from the periphery, from Greece, Ireland, Italy, Portugal, and Spain, the non-GIPS euro area banks, and the non-euro area EU banks, which should be less affected by the ECB intervention in the first place. So we can separate this out and investigate how money market funds are flowing. And I hope you can see that the line at the bottom, the red line, there was already in terms of amounts less, but money market secured funding or unsecured funding disappeared completely for the GIPS banks. We see also for the non-GIPS banks, this is the sort of like light blue dotted line, which is also decreasing and then is increasing, and then to some extent a small decrease, but relatively stable unsecured funding to the non-euro area EU banks here. And we see that, as I said, reverting particularly for the euro area, but the non-GIPS banks here in our sample. And this is the repo funding for the same types of banks. We do not have repo funding for GIPS banks in our sample, but here we can see that the repo funds sort of increase first for the non-euro area EU banks, but then it decreases substantially. So this indicates that there is a shift, or again, from the apparently lower risky banks back to the high risk banks, and this is what we then try to capture also in our empirical part. And I think I don't want to put too many numbers here, but this actually supports that during the crisis periods we see a massive decline in funding to the GIPS banks and a substantial increase afterwards after the intervention in the post-intervention period. And I think this might be interesting for some, so I tried to plot particularly also for the Italian banks, how money market funds was flowing. So the upper panel, we see the UniCredit and Intesa San Paolo, and they lost basically access to money market funds, to the unsecured, completely in 2011, and funding has not returned yet, at least until August 2014. So the second question, are the money market funds able to differentiate between high and low risk banks? So we fix before the crisis starts whether or not a bank is high or low risk to avoid some endogeneity issues along the way, and we do use CDS prices to do that. And if we look at this, just simply high versus low risk funding, unsecured funding to high versus low risk bank, we see a substantial decrease of the unsecured funding to the high-risk banks, particularly high relative to the unsecured to the low-risk banks, even though we see some decline here as well, but the decline is substantially larger for the high-risk institution. And here there is this, in the repo funds, we see this kind of substitution a little bit clearer. Repo funding is decreasing for the low-risk banks, but it's increasing for the high-risk banks to the extent that high-risk banks are able to borrow from money market funds. They are only getting funds on a secured basis. This is what this says. Okay? And we do a couple of robustness tests. We exclude the GIPS banks completely from the sample to make sure that this is not also driven by a market segmentation effect, and overall the fact that money market funds is returning to these high-risk banks, again, after the ECB intervention, is a strong evidence for reduction of market discipline in the later part of the sovereign debt crisis. And I think this is a very nice result also if we differentiate money market flows to banks which have a high or low exposure to GIPS securities. This is what the right column here says. We can see that banks experience substantial outflows, particularly if they were highly invested in the GIPS sovereign debt, and then until the end of 2012, funds were returning particularly to those which have high exposure to the GIPS sovereign debt here. So I think this is the last piece of evidence on that. We do a couple of other tests. We look at different haircuts in the money market funds, but consistent with other literature, we do not see any impact on that. Large funds which have larger investments, and funds which have particular exposure, this is what I meant, to the Eurozone. There we see a substantial reduction in funds as well, in fund flows as well. I don't want to take too much time. We investigate maturities. Maturities is another way of looking at or reducing risks. So they can just simply reduce maturities. This is what we see. We see a substantial reduction in the maturity of funds to these banks. And this also reverts after the ECB intervention. So maturities lengthen substantially afterwards as well. And let me jump to my conclusion. So we see substantial run on unsecured funding for the high-risk banks in summer 2011. This reverts after the ECB interventions, which is consistent with the at least the mitigating of market discipline and the policy implications. So which is actually suggests that the ECB intervention reduced the pressure on the national governments or the national regulators before the banking union started to actually do something to reduce the risks of the national banking sector. And this is exactly what the comprehensive assessment, or one of the things that the comprehensive assessment last year tried to do. Avoid this sort of forbearance, recapitalize the banking system, other work that Viral and I have been doing last year suggests that this did not happen to the extent that was actually desirable. So the implications of that for the stability of the Eurozone, so if we still have these high-risk banks in place, what happens if market discipline returns and we see a substantial decrease in funding to these institutions as well? So thank you very much for listening, and this concludes my presentation.